welcome to this explainer. I am so pumped for this one because today we are stepping right into the shoes of an expert investment analyst. We're going to run ROST Store's Q1 2026 financials through a totally rigorous valuation gauntlet using 5 of the most legendary investment frameworks out there. We're talking Warren Buffett, Peter Lynch, Benjamin Graham, discounted cash flow, and comparable multiples. So let's dive right into this masterclass and see what the numbers are really telling us.
Here's our game plan. We'll kick things off with a quick company snapshot. View the stock through the lenses of Buffett, Lynch, and Graham, run the math on DCF and multiple valuations, and then wrap it all up with our final verdict. Easy enough, right?
All right, part 1, the company snapshot.
Based on our latest data, ROST Stores, trading under the ticker ROST, is sitting at a pretty hefty premium. We're looking at about $233.46 a share, which commands a massive $74.23 billion market cap. I mean, this stock has been on an absolute tear, up nearly 66% year over year. So the market? Yeah, they clearly love what ROST is doing right now. And what exactly are they doing to earn that? Well, ROST operates over 2,200 stores under the ROST Dress for Less and D's discounts banners. Their whole off-price treasure hunt retail model is literally firing on all cylinders. Check this out. In just the first quarter of 2026, sales surged 21% to $6 billion, driven by a staggering 17% increase in same-store sales. That is the highest comp growth in their entire 40-year history. They are pulling in customers across the board with killer merchandising and really aggressive new store expansion. It's an undeniably phenomenal business, but, we have to ask, is it a phenomenal investment?
Let's move on to part 2 and look at this through the Warren Buffett lens.
It's actually wild how well ROST lines up with Buffett's core principles. Economic moat? Oh, absolutely. Their off-price, in-store treasure hunt experience is notoriously difficult for e-commerce giants to replicate. Earnings consistency? For sure. They've got a rock-solid track record. High return on equity? ROST boasts a phenomenal 36.7% ROE, which is way above market averages and shows incredible efficiency. And debt? Highly manageable. They've got a super conservative debt-to-equity ratio of just 0.1 and over $4.1 billion in cash just sitting on the balance sheet. Frankly, Buffett would absolutely love the fundamentals of this business.
But wait, Buffett isn't just about finding good businesses, he's all about finding good prices. He looks really closely at owner earnings, basically the true cash flow a business generates for its owners. For our proxy here, we're using the trailing 12-month free cash flow of $630 million. Now, when you stack that $630 million up against a $74 billion market cap, you get a free cash flow yield of less than 1%. Add in the fact that the stock is trading at a 32 times price-to-earnings multiple, and, well, Buffett would likely demand a much steeper price drop to get that crucial margin of safety he always requires. Great company, sure, but Buffett would likely wait for a much better pitch.
All right, part 3. Let's switch gears to the Peter Lynch lens.
So Lynch famously categorized stocks to know exactly what kind of beast he was dealing with. Historically, ROST has been your classic stalwart, a reliable, consistent compounder offering steady returns. But if we look at their Q1 26 blowout, where total sales grew 21% and earnings per share surged an incredible 37% to $2.02, Lynch might argue that ROST is temporarily acting like a true fast grower. I mean, management even raised their full-year EPS guidance to a range of $7.50 to $7.74.
Now, to figure out if the price is actually right for all that growth, Lynch relied heavily on the PEG ratio. That's the PE ratio divided by the growth rate. Right now, ROST has a PE of 32.1. If we divide that by management's projected full-year EPS growth of roughly 13% to 17%, we get a PEG ratio of roughly 2.1. Now, Lynch typically looked for a PEG of 1.0 or lower to signal a good deal. Also, just as a quick side note, since our 8K filings don't give us the data on insider buying and institutional ownership, which are totally key Lynch metrics, we have to just assume neutral activity there to fill the gap. So the bottom line here, while the balance sheet is pristine, a PEG of 2.1 tells Lynch that the stock's price is seriously outpacing its growth. For Lynch, this one is likely a hold until earnings can catch up to that multiple.
Moving to part 4. It's time for the Benjamin Graham lens.
Let's put ROST through Grimm's famously strict defensive investor checklist. Adequate size? Total breeze at a $74 billion market cap. Strong financial condition? Yep, another pass, with $7.5 billion in current assets dwarfing their $4.9 billion in current liabilities. Earning stability and dividends? Pass again. They literally just bumped their quarterly dividend by 10%. But look at that last hurdle. Moderate PE and price to book, hard fail. Graham wanted a PE under 15 and a price to book under 1.5. Ross is sitting at a 32.1 PE and a massive 11.8 price to book.
And honestly, this brilliantly illustrates why Graham would struggle with this stock today. When we plug ROST into Graham's strict intrinsic value formula, that's the square root of 22.5 times the trailing EPS of $6.61 times the book value per share of roughly $19.70, it spits out a fair value of roughly $54 per share. At a current trading price of $233, Graham would see a massive, glaring lack of any margin of safety. Now keep in mind, Graham's formula is notoriously punishing for modern, asset-light, high ROE businesses, but from a strict classic value perspective, ROS is vastly overpriced.
Part 5. DCF and Multiple Valuations.
So, leaving the legendary qualitative gurus behind for a second, let's put on our quant hats and build a base case discounted cash flow or DCF model. We'll explicitly state our standard assumptions here. First, we establish our baseline using that trailing 12-month free cash flow of $630 million. Second, we assign a 9% weighted average cost of capital, or WACC, as our discount rate to account for the risk and the time value of money. Third, we set a perpetual terminal growth rate of 2.5%, assuming ROS just grows slightly faster than the long-term economy. Let's see what these numbers actually yield.
When we run a sensitivity table adjusting those WACC and terminal growth assumptions, the results are, well, pretty sobering. Our base case at a 9% WACC yields an implied fair value of just $30 per share. Even if we drop that discount rate to a very generous 8%, the implied value only reaches about $36 per share. The DCF model utterly struggles to justify a fair value anywhere near that current $233 trading price. Why? Because the market is pricing in exponential, sustained cash flow growth that is just way, way beyond their current $630 million baseline.
But wait, the narrative totally flips when we use our final model, comparable company analysis. When we stack ROS up against its direct off-price peers, like Burlington Stores and TJX companies, ROS's enterprise value to EBITDA multiple of 20.6 and its forward PE of roughly 32 put it exactly in line with the sector medians. So, while the absolute valuation models are screaming that ROS is expensive, relative valuation says it is priced perfectly appropriately for a best-in-class retailer in today's market. And finally, Part 6, our synthesis and final verdict. Bringing it all together, we've got a seriously stark divide. Strict, absolute mathematical models, like Benjamin Graham's formula and our DCF model, they both scream sell because the current price requires unrealistic future cash flow growth to mathematically justify itself. On the flip side, pure multiples suggest it's perfectly valued, implying a hold. Meanwhile, our quality gurus, Buffett and Lynch, they'd both recognize an incredibly well-managed wide moat business for sure, but they'd likely balk at that premium price tag, also suggesting a hold until the multiple contracts a bit. So ultimately, as an analyst, you're basically weighing a fundamentally phenomenal retail business against a sky-high premium valuation. The strengths? Undeniable. 17% comp sales growth in Q1 is practically unheard of in mature retail. Their 36.7% ROE is elite, and a $4.13 billion cash pile means they are practically bulletproof. But the key risk is that a 32.1 PE valuation offers absolutely zero mathematical margin of safety. If consumer spending slows down, or their execution slips even slightly, this stock price has a long, long way to fall to meet its intrinsic baseline.
So, based on this entire masterclass analysis, ROST Stores is an incredibly well-run company with stellar management. But as an investment today, it's a cautious hold. You are paying for absolute perfection, and in the stock market, perfection is an incredibly difficult standard to maintain year in and year out.
Which leaves us with one last thought for you to chew on. You know it's a stellar business with a proven resilient model, but discipline is the hallmark of any great investor. So with such a great underlying business, at what exact price point? Maybe $150? $100? Would ROST Stores finally become your personal treasure hunt? Thanks for joining me on this explainer. Keep learning, keep analyzing, and we'll catch you in the next one.